If you're any of the following 5 types of people, you need to stay away from insurance, savings, or investment policies. Over the years, I have seen people lose money undeservingly, and not because insurance companies are bad, but because you are not perhaps informed or correctly advised before you commit or committed to this long-term contract. The COVID pandemic came with events that forever broke my heart, seeing how young people lost money. And in this video, I'm going to show you why you should stay away if you're any of the following types of people, and consequently give you an option or alternative that could help you achieve your financial goal. My name is Brian. I'm a financial consultant, and if you're new here, please consider subscribing or follow for more educative financial and investment content. So number one, if you don't have a stable job, please step back. Let me explain. Who are these people without a stable job? These are those people who depend on unreliable payments such as commissions, who are in businesses that are neither here nor neither there, or with constant revenue, whose jobs are dependent on factors like, boss well-being. My boss, if my boss is going down with his business, then I'm done. If my boss is sick, then my job is dead, or I might not end up getting any salary till my boss recovers. Insurance policies are long-term commitments which require not less than 5 years of commitment, and most of them are very strict. You need to keep your side of the agreement, which is paying premium in time, and failure to do that, you may attract penalties or have the policy collapse. If that sounds like you, then please consider other alternatives like saving your money in the money market fund accounts and save yourself some premium tears. And number two, if your job contract is less than the policy term, run away from those long-term insurance policies, please. If your job contract will last for say like 2 years and then be considered for a renewal, which is probably not guaranteed, and here you are signing up to a 5-year or 10-year policy, who do you expect will continue paying if in case your contract is not renewed? Do you think anybody is going to understand and go like, oh, sorry, your contract was not renewed, and then we're going to give you back all your savings just because you're going through a hard time? Hey, but not to say that you cannot sign up entirely under these conditions, because you can opt to do something like make payments in advance. For example, if your monthly payment is supposed to be something like 10K or 10,000, then you can have something like 30,000 or the best calculated amount and put it on a standing order or on a debit order. And this will be for those years that you have in contract, and therefore to be able to pay the total premiums for the entire term in advance, just in case your contract is terminated or not renewed. In that case, you don't get to lose the rest of your money. But if you're unable to pay it in this way, just stay away and put your money somewhere like the money market funds where it is safer. Number three, if you do not have an emergency fund or an emergency savings, hey, why in the name of God are you committing to something that could completely, literally kill you financially? Before I proceed, let me educate you what an emergency fund does. From time to time, we all run into situations or issues that require our financial input. Some might be medically related, some family related, but whichever label it comes with. By the time it is an emergency, it means that whatever needs to be done has to be done. And in other words, it has to be taken care of by all means. Sometimes it might mean that most of your disposable income or more than your income itself has to be redirected to settle those emergencies. And whenever something like this happens, the first casualty, I want you to hear this, the first casualty is usually your insurance policy, by the way. Hiyo ndo unaacha kulipa kwanza. And at the moment, nobody will understand that you have an emergency. so that they waive your premiums and tell you, okay, stop paying your premiums, it is okay. Of course, there are some products which have been designed nicely to give you something called a premium holiday, whereby you can just chill and might have up to 6 months without paying premiums and still come back to continue with your policy. But this always comes with a catch 22. Something like it's only available once in 5 years. And then, so what if you got another emergency soon after you have already consumed your first premium holiday? Premium tiers. Perhaps if you had an emergency fund and anything happened to you, you will have a solution that does not mean that you interrupt your normal obligations like paying premiums. I wish I could say this louder or in capital letters. Please, before you commit to a long-term savings or insurance plan, ensure that you have an emergency fund which is not less than 6 months worth of your expenses or income. So first things first, tell them I like this product, but let me first of all raise my emergency fund. And when I hit my goal, I will commence the long-term policy instantly. Another solution, if your disposable income allows you to, you can have the two running concurrently. Have money sent to your insurance company, yes, and have the rest sent to your money market fund account for the emergency fund. Now that one will kill two birds with one stone. Clever option, right? Number 4. If your intention is to use an insurance policy as an investment plan or savings plan, hey, step back, my friend. Just step back fast and rethink your plan. You could be saying something like, but Brian, that was the idea all along. I know. And there are circumstances under which you might have to take something like an education policy based on very low disposable income that cannot be able to take care of your savings and risk protection when they invested separately. But if it's just an investment or saving plan, you are wasting both time and money and putting a loaded gun on your head. Most of the policies, by the way, that are considered to be savings plans are only but insurance policies, which are protection policies or life covers. But I think, in my opinion, these are the biggest regulated scam ever devised. And this is because you get to pay so much for the protection side, but what you get in return, is not worth what you are paying for. Just to put it into context, what most people don't know is that the money that you save every other month is divided into two, whereby one portion of the money is invested, as in it is the savings or the investments plan side, and the other portion is taken away as premium payment for protection, which is the insurance side. So depending on how the product has been designed, your investment or saved amount could now vary, you see, for anything from between, say, 50% to something like 80% maximum. And this, therefore, at maturity, is the only money that you expect to be calculated and be given back to you. And this is just in case it breaks even during the investment or policy term. Honestly, you don't expect much from such a small invested portion compared to your full amount of contribution being invested fully. And though there could be benefits like, say, something like tax relief, but you see, in Kenya, you only get to enjoy that if the policy term is beyond 10 years. The flip side of this is that since the saving policy is interconnected with the insurance, then the ugly side of the insurance rubs on it. Things like failure to pay premium attract penalties. Discontinuing to pay premiums might lead to your policy lapsing or collapsing, and all your money goes up in smoke. The 5-year policy or thereabouts, and also most of the long-term ones, are not investment policies, are not savings policies, and they do not have a worthy return on investment. If you can separate the two and take a pure protection and a pure investment plan, then stick to a money market fund until you can be able to do that. And now, last but not least, if you do not have someone that could suffer immediate financial loss, please practice some self-love, my friend. Focus on yourself for the time being and build your investment using 100% of your income or available disposable funds. Do not waste time paying for protection, which is unnecessary. Yeah, that 20% of your investment or savings that is going to pay for your premium protection or life cover basically means that every time that you invest money, you put in 10,000, 20% instant loss. Because 20% is paying for something that you don't need. So every time that you deposit, even if you gain 10% or 15%, you already went to loss of 20% instantly. And that return on investment will take forever to break even if it ever does. And you will need a lot of compound interest and a lot of mathematics to make that one work. But this is not to say that insurance companies are bad or that they are not important. But I think we have gotten to a time where insurance needs to go back to what it really was or was meant to be, which is ensuring protection by offering pure risk products and isolating savings and investments from this lot. The other thing is to have honest financial advisors who will prioritize you, the client, and not commissions in their pocket, which is such rare thing, by the way, to be able to advise you, who can be able to advise you to make the right decision at the point of sign up, without thinking about their pocket first. And by doing this, we will ensure that we minimize the unnecessary losses that are hitting innocent investors who thought that they were basically saving or investing. If you found this helpful, please don't keep it to yourself. Make sure you like and share it to another person. Let them not fall victim to the same. Thank you so much for watching, and I can't wait to see you in the next video.